Let's now move to our first technical session, which is on possible priorities and outcomes in the finance track. To chair the session, we have Dr. Shankar Acharya, Honorary Professor, ICRIER, and former Chief Economic Advisor, Government of India. Among the speakers, we have Dr. V. Anantha Nageswaran, who is the Chief Economic Advisor, Government of India. Dr. Poonam Gupta, who is the Director General, NCAER. And Mr. Ramanathan Subramanian, Executive Director, RBI. We also have two discussants, Dr. Louis E. Breuer, Senior Resident Representative for India, Nepal, and Bhutan, IMF, and Dr. Nella Hendriyetty, Director, Center for Regional and Bilateral Policy, Ministry of Finance, Indonesia, who is joining us online. Hi, Nella. May I check with you, Nella, if you can hear us?
Yes, very clear.
Great, great, Nella. Thank you. Over to Dr. Acharya for moderating the session. Thank you.
Thank you. Well, all of you know, first of all, can everybody hear me? As you all know, that the theme of this particular session is possible priorities and outcomes in the finance track of the G20. As Mr. Kant emphasized, there are two major tracks, the summit track and the finance track. So this particular session is going to focus on the finance track. I should mention at the outset that we have, I think, five people who will speak, three speakers and two discussants, aside from myself. And I think we also have a promise from, I think, Pooja to do a little summary. Can see that at the moment. Okay. Well, that's why I can't see you, because you're behind the photographer. So that's a lot of speaking, and we only have an hour and 15 minutes. But that's why I turned to Dr. Deepak Mishra for guidance on this, and he very helpfully sent me a WhatsApp this morning saying that it's going to be, for each speaker will have 12 minutes, and each discussant will have 7 minutes. The chair, that is myself, will have 5, and Pooja will summarize and draw out the kernel of the discussion in 5 minutes too. Good luck to that. I should actually have started by mentioning at the outset, which I didn't, but let me do that I'm really, in a sense, a stand-in chair, which I got activated sometime late yesterday evening, because essentially the person who would have been in this chair would have been Secretary of Economic Affairs, Mr. Ajay Seth, and he got held up in Mumbai for various work reasons. and couldn't make it back in time. So you'll have to forgive me if I look and sound a little underbriefed, but I'll try and do my best. Now, so to begin with, if I can invite Dr. Anantha Nageswaran to be the first speaker. I'm sort of going to take it for granted that everybody has biodata and all in their various folders or on, they looked at it on the net. So I'm not going to give detailed introductions, but everybody knows also that he is, Anantha is a Chief Economic Advisor and has been for quite a few months in the Ministry of Finance, which is a key position. And it's going to be, I think he's at the fulcrum in many ways of the finance track, preparation, thinking, and so forth within Finance Ministry and therefore the Government of India on this. So I think it'd be terrific to hear from him on this topic.
Good morning, ladies and gentlemen, and thank you, Dr. Acharya, for those kind words of introduction. We did hear the enormous and formidable challenges under which the circumstances under which India will be assuming the G20 presidency in about 30 days from today. So in that sense, this conference could not have been timelier. And I'm very confident and hopeful that this conference will offer insights to help us steer the G20 presidency and the issues effectively over the next 12 months. One of the requirements, but not necessarily sufficient, but necessary requirement to ensure that we do a good job of the presidency is to be able to improvise and be flexible as circumstances emerge in the global economic and political landscape, and it applies even to logistics. And that's exactly what happened today. Due to a last-minute preoccupation on the part of my colleague and Secretary Economic Affairs, Mr. Ajay Seth, I have to now develop a little bit as a panelist myself and also share some of his remarks. So I hope this exercise will persuade you to some extent that we can improvise and rise to the occasion. Quite clearly, along with the Honorable Finance Minister, Secretary Economic Affairs is the more important architect of the finance track than I am. Therefore, please indulge me as I share some of the thoughts that he would have liked to share today before I move on to my own remarks as well. As we have heard multiple times this morning as well as before, that the global economic environment is subject to so many headwinds and uncertainties that we will be spending more than a day recounting them. To use a Rumsfeldian phraseology here, we are not dealing with known unknowns, but really unknown unknowns. Under these circumstances, the objectives of the Indian presidency under the finance track will be to focus on key issues of macroeconomic vulnerabilities in the near term, which deal with food and energy insecurity, which have arisen partly because of long-standing underinvestment in energy infrastructure, but also because of near-term geopolitical developments. Looking further beyond, it will be important to see how multilateral institutions can be strengthened, both in terms of governance and in terms of the capital and resources they command, to be able to serve development needs of countries as well as global challenges, which also affect smaller and lower income countries more than they affect others. So in that sense, the multilateral financial institutions must cater to global public goods, as well as continue to engage in development financing that they were mandated to do at the end of the World War II as well. And of course, in this regard, it is not just about capital adequacy that they have, it's also about additional capital that they may need, for which today's developed countries will have to take a call on how they are going to contribute to that. The third objective of the presidency would be to identify consensus-based solutions for accelerating the scale and scope of the response of the global community to many transboundary challenges, such as regulation of virtual assets, dealing with cross-border remittances, and also the issue of global capital flows, and how to create buffers and safety nets for developing countries that get affected by spillovers from developed country policies, etc. So as you can see, the list is quite useful, interesting, important, but also answers are not going to be easy to come by. Therefore, we have been engaging with institutions like ICRIER and as well as ICRIER, international organizations, individuals and experts. That exercise has just begun and we will continue to do so. We remain very grateful for their support in helping us flesh out some of the ideas and also come up with some practical solutions that would be acceptable to a broad range of participants in the G20 as well. At the same time, considering the rapidly evolving and shifting nature of geopolitics, India remains flexible to recalibrate its agenda as may be necessary. And as Sherpa Mr. Amitabh Khan so eloquently spoke, there is close coordination and collaboration with the Sherpa track as well to make sure that there are several cross-cutting issues such as climate finance, climate and development agenda, evangelizing India's public digital infrastructure, including ensuring interoperability across borders, as well as ensuring that India's experience and knowledge can be shared within the G20, etc. We will be working very closely in collaboration with the Sherpa track. And also, it is very interesting that as we assume the G20 presidency, we have Japan, which should be taking over as the president of the G7 next year, and UAE will be hosting the COP28, and Indonesia, which is just going to complete its presidency of G20, will be leading the ASEAN grouping as well. So in that sense, it's very useful for us that we will have the, given the excellent relations we have with all these countries, it will be very good that we will be able to collaborate with them and make sure that the positions that we put forward are as synchronized and as consistent as possible. Before I move on to talking about the finance track issues or challenges, I have to make a special note on the speaker representing the Indonesian presidency, Ms. Nella Hendriyetty. She's the Director, Center for Regional and Bilateral Policy, Ministry of Finance, Indonesia. So we have to now take a moment to thank the Indonesian presidency and appreciate and recognize its exemplary efforts in keeping the momentum on G20 conversations going, despite multiple challenges that have been highlighted here. In fact, India will build upon the spirit of multilateralism that the Indonesian presidency managed to keep aloft in 2022. So with those words of setting the stage and the context, I would like to share with you the issues or the priorities for the finance track, but in no particular order of importance. I'll start with debt vulnerability because in our neighborhood in the last year plus, we have been dealing with the challenges that Sri Lanka is facing. Needless to add, this issue is critical. It is important for developing countries for sure, but in fact, given the state of affairs of finances in developed countries as well, it may become important even for some developed countries down the road, particularly in Europe, given the kind of economic slowdown that is anticipated over there. So debt vulnerability is an issue that affects not just today's developing countries, but also countries that are regarded as developed, but which have developed over the years, massive financial vulnerability because of their reliance on central bank munificence over the last 14 to 15 years. The question is, not one of whether to provide relief. There is consensus on that. But the question is one of who would provide the relief and how, and who will do the burden sharing among the creditor countries. So that is where the common framework has to become more effective. And we may have to look beyond the Paris Club as well, because today creditor countries go beyond the original Paris Club members of creditor members. But related to debt vulnerability is the question of global capital flows, because debt vulnerability builds up during good times and goes unnoticed. Just a couple of days ago, Dr. Aravind Subramanian had indeed a good piece in Project Syndicate calling for financial deglobalization. And in particular, he dealt with the issue of capital controls. So the question is, capital flows across borders happen, leading to debt accumulation in good times when risk appetite is high. So it is not so much about opening the umbrella after the rain has started, but it is about ensuring or preempting the buildup of debt vulnerability in good times. Is capital controls the way to move forward? But developing countries themselves do not take the necessary efforts in good times, because when capital does come in, it obviously contributes to economic growth, rising asset values, etc. Investors on their part from developed countries do not want restrictions on capital flows, both in and on the way out. But unfortunately, beneficiaries want to restrict capital flows mostly on the way out, not on the way in. So you can see the divergence between the positions of investors as well as developing countries here. So in this tussle or battle between sovereigns and investors, at the moment, the balance of power rests with capital providers. And that is where I think translating the recommendations, for example, that Dr. Subramanian has put forward will be quite an interesting challenge. But it is good to note that in recent years, the International Monetary Fund is slowly shifting its position on the preemptive application of capital controls. But more needs to be done in order to make it mainstream and a legitimate policy tool. And hopefully our presidency can take this progress forward a bit more. Related to capital flows is the issue of financial globalization. The most recent episode, but not the only one, and not the most egregious one, is the question of leveraging adopted by pension funds in the UK, which are by definition supposed to be risk averse and boring fund managers. Investment strategies that on the face of it that sound harmless, liability-driven investing, have had enormous leverage built into them as returns dried up. Some of these strategies are conjured up by the financial services industry, and we know that how some of them helped grease high-risk public debt. And in the 2008 crisis and in the run-up, credit default swaps were created and allowed to proliferate. And these were essentially credit default insurance products, but they were renamed as credit default swaps to avoid regulatory oversight. And that we know that CDS brought down the world of finance almost in 2008. Therefore, financial globalization or financialization is the dominance of finance over the real economy, a case of tail wagging the dog. Therefore, how do we deal with financialization or financial globalization? How to make finance a servant of the real economy rather than the master? And given that Europe is somewhat more favorably inclined towards regulating global finance, is it possible for G20 to arrive at some kind of a consensus on the way forward in making sure that finance serves the purpose of the real economy and not the other way around? But the question of why investors and even pension fund managers go after risk is the next issue that we have to deal with. And that takes us to the issue of spillovers. We have to consider, when we discuss spillovers, we have to consider the monetary policies of the last 20 years, or maybe the last 13 to 14 years, if you want to be very precise. Quantitative easing, zero interest rates, negative rates, all of them dried up returns on safe assets. Therefore, investors were encouraged to go out to the frontiers of the risk curve. Financial risk-taking coincided with inadequate risk-taking in real economy. Therefore, financial claims on real assets surged, resulting in bubbles in speculative assets. In this manner, extreme monetary policies, along with hands-off regulatory policies, facilitated and encouraged financial globalization or financialization. So we know what really happened here because of policies adopted elsewhere that gave rise to multiple phenomena which have created a problem today, because everywhere central bankers are keeping one eye on the real economy and one eye on the financial economy to make sure that the kind of tightening room that they need is not thwarted by any financial accident. And that is partly because of what went on in the previous 13 to 14 years in terms of some of unconventional monetary policies. And that is what has caused this whole spillover risk today. But let's be very clear. Spillovers have always been there since there is no one global central bank regulating global interest rates, global money supply, etc. The moment one currency was installed as the global reserve currency, the impact of its policies would naturally spill over on the rest of the world. And that has been the case since the end of the Bretton Woods or even before. Same thing has happened in the Euro area as well, with the policies of the German government through the Deutschmark became cost spillover effects in Europe, because Deutschmark became the anchor currency for Europe, just as dollar became the global reserve currency. Therefore, the collapse of the Bretton Woods regime itself was a spillover event, as was the exit of the pound sterling from the exchange rate mechanism in Europe in early 90s. But what is new about spillovers today is the magnitude, amplified by extreme or unconventional monetary policies, about which I talked a bit earlier, pursued for a long period. After all, we all know from the textbooks that monetary policy is a short-term aggregate demand management tool, but we wouldn't have known that, considering how long zero rates or negative real rates or quantitative easing remained in the policy books, actually. So these policies have been pursued for a long period, unmindful of their unintended consequences, even as intended consequences failed to materialize. Therefore, we can see now that debt vulnerability, capital flows, financialization, spillovers on low-income countries or poor countries of policies followed elsewhere can all be traced to the policy paradigm that has prevailed in the last 3 to 4 decades, actually. That paradigm has given the pride of place to monetary policy. Fiscal policy kind of got downplayed. And as Paul Tucker wrote, unelected power of central bankers dominated the elected power, which had a greater influence over fiscal policy. Addressing these challenges or delivering on these priorities will require an overhaul of the macroeconomic, regulatory, and monetary policy frameworks of the last 40 years. It's not going to be easy, but we hope we can make a beginning during our presidency. Once this underlying framework is recognized as the root of the problem and a beginning is made in fixing it, then many of the related issues will solve themselves given time. And of course, during the time that it takes to solve these issues, short-term financial support needs to be made available to vulnerable and poor economies. I would be remiss if I don't conclude my remarks without talking about the issue of climate finance. The quantum of climate finance, availability, the terms on which such finance is made available, blended, whether it is public and private, all these issues and disclosure standards, all these issues will be part of the climate finance agenda. It is not just about securing money. It's about the various package terms and conditions, paraphernalia that go with it. For example, the International Sustainability Standards Board came up with its draft sustainability standards and climate disclosure standards in June. And the requirements are so comprehensive, onerous, and may even be beyond the capabilities of even well-funded, well-capitalized, large corporate entities in developing countries. In fact, some of you might have read that several financial institutions have even left the Global Financial Alliance G funds because the information requirements were very onerous. So you can imagine what would be the information requirements for developing countries and smaller businesses. And if those information is not provided by them, then the flow of funds will get affected. So we need to also address this issue of disclosure on sustainability and climate matters, and that would pave the way for blended finance or private finance to flow. And these disclosure standards have to take into consideration the principle of common but differentiated responsibilities and respective capabilities. So these are all the kind of issues that we will have to deal with in the finance track during the presidency. Last but not the least, there is a need to balance growth aspirations and climate considerations for many developing economies, because we have forgotten that the pandemic, the commodity price shock, and the monetary tightening in developed world have all basically derailed the growth path that many countries would have expected at the beginning of this decade. So in that sense, in all the discussions about climate finance, etc., we forget that ultimately economic growth is the most important insurance and source of resources for them to be able to invest in these longer term considerations and priorities, which are important for today's developed world, because in the Maslow's hierarchy, they have taken care of the initial existential needs, but many developing countries are not in that position. And therefore, to balance growth and climate considerations, it is important to recognize that carbon mitigation is, for developing countries, relatively speaking, a future problem. And of course, we also have to make sure that we account for the atmospheric carbon that already is there. So accounting for it and accountability both have to go together. That discussion has to happen. Therefore, the emphasis on mitigation and carbon pricing as a very important mechanism on the part of international organizations and developed nations has to be balanced with the recognition of legitimate growth aspirations for developing nations. So as you can see here, when it comes to climate, as other matters in the finance track, there are multiple touch points. Let me conclude. The G20 forum indeed is a useful one. There is no doubt about that, because it has provided a platform for developing countries to voice their priorities, concerns, aspirations, and their requirements as well. It is a small baby step, but an important one to leveling the playing field in the years to come. In fact, the question to ask is, if there was no G20, would there be a need to invent it? And the answer is yes. That answer underscores its usefulness. At the same time, while it is true that platforms such as these facilitate dialogue, conversations need to happen for platforms to remain legitimate. And in today's fractured world, having the conversation itself has become a challenge, as the Indonesian presidency would testify. To the extent that global politics and global economics are in a crisis, in a way is a blessing in disguise, because it's always crises that provide solutions and opportunities, because minds get focused like in no other time when there are crises. So that should be actually taken as a disguised silver lining here. We hope we can look back in November 2023 and say that collectively we made a difference for the better. That is the hope, prayer that we have. We need your support, and we need all the luck and chance that the forces of nature or the Almighty can bless us also with. Thank you very much.
Thank you very much, Dr. Nageswaran, for what I found, as someone listening, to be a very substantive set of remarks. And I think that you really gave us a lot to think about, and you didn't hesitate to take intellectual positions, as I at least heard you. I'm not going to try and cover all the things that you've said, because everybody heard that, but I can't resist saying one thing, that knowing that you come from a finance background, as far as I know, in your past lives, I was I was very pleased to hear you using phrases like that finance has to be the servant of the real economy and not the other way around, and that you emphasize the risks of excessive financialization, particularly in the global marketplaces. And I cannot resist mentioning something which goes back in history about a quarter of a century. That's just perhaps an indicator of my age. That back in the mid-1990s, there was a strong move in the International Monetary Fund. I don't know, Dr. Breuer, if you are aware of this, to introduce a new article of agreement dealing with capital convertibility, capital account convertibility. It was something, it was led very much by the United States, particularly at that time, Lawrence Summers. It was, I think, either Deputy Secretary of the Treasury or something like that. Something that we in India were extremely concerned about, because it was only 4 years after we'd come out of the balance of payments crisis, and we certainly didn't want to have the IMF breathing down our necks to kind of move rapidly or over rapidly towards capital account convertibility. And, we tried to get together a coalition of other developing countries who similarly minded. I don't know whether our moves would have succeeded, but actually a set of events took place that, again, I need to be reminding an audience of what happened, which was, of course, the Asian financial crisis of 1997-98, which was in some ways a precursor, though at the Asian stage, of excessive financialization and perhaps premature moves towards capital account convertibility. Of course, one of the, it did a lot of damage, that crisis, but one of the, I think, collateral benefits was one stopped hearing about any new article of agreement in the IMF regarding capital account convertibility. So as someone who was, I had at that time, Dr. Anand's position in the finance ministry in India. So I was in some sense in a hot seat. I can say that, crises are not only opportunities, but they can sometimes have collateral benefits. But with that, if I can, now, as many of you would have noticed, I was quite indulgent about the 12 minutes that was allegedly allotted to Dr. Nageswaran. I felt he is speaking from the pulpit of the finance ministry. One needed to give him all the time he wanted. So I made no efforts to pass him any slips. I fear that this indulgence may not be extended to other speakers. And so I would just remind you that Poonam and all the others, that what I said earlier on the advice of Deepak, if you would kindly bear that in mind. With that, it's my pleasure to not introduce, because she's well known, but request to speak Dr. Poonam Gupta, who heads and has headed for more than a year the National Council of Applied Economic Research, one of the premier think tanks we have on the Indian stage. Please go ahead.
Thank you. I didn't wait for an invitation. I just came and stood here as soon as Anantha was done. Anantha, that was a brilliant address that you gave. And we are very happy to be a partner, a knowledge partner of the Ministry of Finance in the finance track. So what I'm going to say today is really going to complement what Anantha said, and later what Dr. Acharya said. So, just like them, I have been working on issues related to capital flows, spillovers, vulnerabilities that emerging markets face because of the monetary policy actions of advanced economies. And in fact, when we say advanced economies, it's really the US. Other countries do not matter as much when it comes to inflows of capital flows to large emerging markets or their outflows. The main points, just to reiterate and to pick up from where Anantha left, Global financial integration has continued to increase. In fact, even post 97, 98, it has not been imposed by the IMF as much, Professor Acharya, but nevertheless, emerging markets are much more financially integrated. As a result, they continue to be impacted by the volatility of capital flows. And we can have another discussion, Anantha, on whether ex-ante capital controls or restrictions can work, given that capital flows have liberalized a whole lot. Ex-post capital controls never work unless you are already in a deep crisis, but that's a discussion for another day. What I'm going to talk about is the nature of these spillovers and capital flow reversals that happen from emerging markets and what can be done about them, at least one part of the management aspect of it. In fact, interestingly, capital flow reversals are not country-specific sudden stops. These are now emerging market-wide phenomenon, and they can be called an emerging market sell-off episode, one of which we are going through currently. These reversals from emerging markets are not strongly correlated with their domestic fundamentals. Otherwise, India, which is currently being considered to be a bright spot in an otherwise gloomy global outlook, would not have experienced the kind of outflows it has. So these are not at all correlated anymore with domestic fundamentals. And what the pitch that I'm going to make as a part of the G20 agenda is the need to strengthen the global safety nets. And I'm aware of the fact that we have representatives of the international financial institutions, including my good friend Louis here, and hopefully he will not take my direct comments personally. These are based on research, and these are in the wider good that we are trying to attain. So episodes of these reversals of capital flows, what I'm calling is not country-specific sudden stops, but emerging market sell-off episodes are becoming ever too frequent. So the frequency is really every 2 years, 2013, 2016, 2018, 2020, and now 2022. What is current in the Indian mindset is 2013 episode and 2022 episode, when India was impacted, in fact, quite significantly in 2018 as well. Those who are forming policies at the time, including at the RBI, would remember this particular episode as well. And it made enough press at the time, and I had analyzed that episode. The modus operandi is that there is a risk of a sentiment that takes over. Capital starts reversing from emerging market. It reverses disproportionately from large and liquid markets such as India, because the idea is to rebalance out of emerging market as an asset class and go to another asset class. At that point, the investors just want to unwind their positions as soon as possible. And it's easier for them to unwind their positions from markets which are large and liquid, such as India and Brazil and Turkey and Indonesia. So these handful of countries get the brunt during each phase of the cycle. When the capital is trying to enter the emerging markets, again, they find it easier to enter large and liquid market, and they find it easier to leave those exactly same markets. These events usually last for a few weeks to a few months. 2022 is exceptional, partly because it's current, we are seeing it unfolding, and partly because it has lasted much longer than any of the past episodes. We're already in month 7 or 8 of this risk-off and reversal episode. And of course, it creates huge challenges for the policymakers, central banks, and everybody else who's invested into the market or exchange rate or otherwise. Now, you know, it's not easy anymore to say what is it that emerging markets can do to insulate themselves, because as a part of the discussions with the IMF or other multilateral institutions, most of the countries have moved to more resilient policy frameworks. They have better growth outlooks. India certainly does. They have stronger fiscal positions. Many of the countries now have fiscal rules that they have implemented for themselves. They have credible monetary policy framework, including under inflation targeting. They have built larger reserve buffers, and they have reduced their exposure to foreign currency. So these are the things that have been advocated for countries to reduce their vulnerability to outflows or to maintain stronger and resilient economic policy frameworks. And flexible exchange rate was also one of them. And most of the countries actually in the emerging world have already done this, including India, as we all know. But it has not been sufficient, as I said, to make them insulated from the capital flow cycles. So this year alone, India has been experiencing rather significant outflows of portfolio capital, which actually at its peak was nearly $40 billion. And the entire asset class of emerging market economies is being impacted during the current episode. India is relatively less impacted, but here I have some of the largest emerging market countries. As you can see, most countries have had significant exchange rate depreciation, increase in bond yields that they have to now shell out, and their equity markets have corrected. So what do emerging markets, including India, do when they face such volatility? There is a certain policy toolkit that's recommended or that's available to them. They let the exchange rate depreciate. They use their reserves up to a certain percent. My co-author and I analyzed the 2013 episode very carefully, and we realized the ballpark was that countries use 5% of their reserves at that time. Exchange rate actually at its peak had depreciated by 22% at that time. They play with monetary policy. In most cases, they increase their policy rate to match the policy rate increases by the US. They adhere to fiscal prudence. They announce so, and they do it through their actions, and they communicate that we are a solid, resilient economy, and we are focused on reform and growth, as the current policymakers have been doing. What else can they do? They can also use certain safety nets. And that is what I'm going to be talking about on rethinking and strengthening the safety nets during the G20 presidency. There are three things that are generally talked about when we think of these safety nets. One is the foreign exchange reserves. So a country can build a significant amount of reserves, which can be used during times of capital flow reversals. Another could be to the extent that these crisis-like situations are liquidity crises. There's nothing wrong about a country. Country is solvent, country is growing, it has resilient policy framework. It's just that a set of investors decide to move out of your country. So it's a liquidity crisis. So the countries should actually have access to more liquid foreign exchange. And that is where swap lines come into play. And there is now a significant literature and experience with the swap lines, and I won't have the time to go into those. But a couple of lines, the two kinds of swap lines that are currently offered. One is by the US Fed, one is by other countries. US Fed has offered its swap line very selectively to a handful of countries, with which it had significant trade and financial links, or the countries it thought was significant for the health of the US economy itself. The other swap lines have been offered increasingly by South Korea, China, Japan. India has had a swap line with Japan, which it has been extending and increasing the cover. And IMF's contingent lines. In principle, there are now 3 contingent lines that exist, which IMF offers, but they are not considered to be highly desirable by emerging markets. And these are the areas on which we can think about making the policy frameworks even more resilient for emerging markets by adding these safety nets. And what exactly do I mean by that? I'll just take 3 or 4 minutes, Professor Acharya. This is really the crux of the presentation. So rethinking the safety nets, how should we do that? You know, this is the time when countries such as India are using their foreign reserves. When this crisis is over, India will have to rebuild its foreign reserves pool to be used when such a situation emerges again. And I said these situations are emerging now at the frequency of every other year. But there's an issue when these reserves are built again. The countries are being called as currency manipulators. by the same countries actually whose monetary policy is creating these cycles, which is the US, right? So when India, having now used up nearly 15% of its reserve stock, will start rebuilding it, it won't be allowed to do it frictionlessly. It will be called a currency manipulator. I think this issue needs to be mainstream to understand that building foreign reserves and using them is a very important part of the toolkit which an emerging market has. The other is swap lines. So countries have scrambled in the past to build swap lines with each other, etc. If India is a large emerging market and there are other countries which are as important, why can't they also have access to a swap line with the US Fed? And again, it's the least that the US Fed can do, given again, the origin of the problem is the country itself. And something like this can be discussed as a part of the G20 discussions. In fact, one can think about a G20-wide swap line arrangement where, in my mind, actually, a swap line with the US Fed is the most credible. Europe has enough problem of its own. Japan has offered us a swap line in the past. And that's pretty much the entire advanced economy pool of countries that we are talking about. So US Fed swap line should be offered much more flexibly to more countries. It can be a part of the G20 discussion. Once these larger countries within the G20 have been offered these swap lines, then they can go back to within their region and in turn offer smaller swap lines to their neighboring countries. India has already had a swap line, if I'm not wrong, with Sri Lanka and Nepal. And India can do it much more credibly and with much more confidence once it has a significant swap line with the US. So this is something that needs to be talked about. It cannot be treated in an ad hoc manner the way it has been, with countries like us left to pick up the pieces ourselves. Another one, and this is where the IMF can play a much more constructive role. So IMF has offered 3 different kind of safety nets, precautionary lines are what they're called. These are precautionary credit lines. The first time they were introduced was in 2009 when 2 lines were offered, flexible credit line and precautionary and liquidity line. One more line has been offered in 2020. Despite nearly 15 years of its existence, it has had a very limited uptake. So the question for the institutions like the IMF is, what innovation is being planned to make these lines of greater use? So here we have done some research to look at, and I knew the numbers earlier, but I just wanted to make sure that its use has not become much more prevalent in the last few years, and my hunch was correct. A handful of countries have signed up for the entire 15 years of its existence for these lines. Only a couple have withdrawn from it. Now, I think it's a resource that's available. If we think about it carefully, it can be a very useful tool for countries. And for that, we need to take the stigma out of these lines. And here I have some practical suggestions. First, why call them contingent lines? We can call them swap lines. These are liquidity lines, right? In order to take the stigma out, let's not wait for a country to apply for them. Let's just include them in the annual Article 4 consultations, whether a country qualifies for any one line, and most countries will, except that if the countries are vulnerable, most emerging markets will qualify for one or the other. Then tell them which line they automatically qualify and what is the amount they can avail if they choose to do so. These contingent lines, whether they're used or not, when a country signs up for them as an insurance, there is a fee that is charged, which is not insignificant. So a number of countries, Mexico, and if I'm not wrong, perhaps Peru and Panama and Colombia have been signing up for these lines over and over again. Over a period of 15 years, despite the fact that they have not withdrawn from these lines, they have paid a significant amount in annual fee. I would say just make them free, take the stigma out. It cannot be a moneymaker for the IMF. Charge money only if a country is withdrawing from these lines. And again, it can be a part of the G20 discussions. So just to wrap it up, I think this issue that most emerging markets are undergoing currently, including India, is an important one, that for no fault of theirs, with very resilient and remarkable policy frameworks, they have to go through these cycles of capital inflows and outflows. They should be able to build and use their reserves quite independently without being branded as currency manipulators. Swap lines by the Federal Reserve Board ought to be more inclusive and large. So a liquidity facility only works when it's large. A half-hearted facility of few $1 billion is neither here nor there. So for example, if India's reserves are $500 billion currently, 100 billion swap line with the US Fed, 100 billion contingent line with the IMF will mean that nobody would be interested or will benefit by speculating against the currency. And that's the kind of numbers we are talking about. These swap lines should be a part of the G20 discussion. And the discussions can be in a way that more or less the entire world of emerging markets and a number of developing countries can then be covered with it. The last bullet point, which I'm going to read out, is the international financial system ought to be fairer and credible for all, and not just to the advanced economies who happen to be the largest shareholders of the international financial institutions. Thank you.
Thank you, Dr. Gupta. I must thank you for also giving a very substantive presentation with fresh ideas. And I think, in many ways, quite practical suggestions that I am looking forward to, in particular, to hear comments on from Dr. Louis Breuer, who is, of course, the IMF's resident representative in India. But I don't want to predict what his remarks are. That's for him to say. But I really want to thank you for an excellent presentation. Now let me turn, last but not the least, as a speaker, to Mr. Ramanathan Subramanian, who's Executive Director of the Reserve Bank of India.
Thank you, Chair. My fellow panelists, distinguished invitees and ICRIER. Good morning, and thank you for inviting RBI to be a part of this event. I'll straight away talk about the RBI's role, approach, and contribution to India's G20 presidency that is coming up. You all heard the Chief Economic Advisor speak about the broader financial issues globally. And the RBI's role will be primarily to support and provide inputs to the government, whereas the broader vision and the theme and the priorities will be decided and laid out by the Ministry of Finance, by the Government of India. The RBI's role will be to provide a supporting role to the ministry in filling up the details and providing various technical inputs. Our broad approach would be, you'd find that a lot of work has already been done by the international organizations, especially the Financial Stability Board and other organized standard setting boards in the area of finance track. Because every presidency tasks the various international organizations with various aspects of financial stability and global financial issues. And a lot of work has already been done. So we will be, as G20 presidency, we will be inheriting a lot of legacy issues. And we intend to, there is absolutely no point in reinventing the wheel. So we will be carrying forward some of the already good work that has been done by institutions like the FSB, and also trying to add value to it. As regards our contribution, as you see, today's event is called Crafting an Indian Narrative on the G20 Presidency. So we will be looking forward to contributing, and our emphasis and focus will be on the Indian narrative. And our contribution will be largely based on the body of work that we have done as policymakers, as regulators in the area of the financial and banking sector. So straight away, for instance, let's begin with financial inclusion. This has been, as you know, that this is a very key area, and the task of financial inclusion has been given to the GPFI, or the Global Partnership for Financial Inclusion, which is an allied body, which is allied to the G20. So they exclusively look after that. So we will be working very closely with them, and we have a lot to offer from India, from our own Indian experience. As you know, that a country like, given its size and diversity and its population, I don't think there is any other country which has greater challenges in financial inclusion and financial literacy than India. And we have a lot to offer there. We are working at the highest level. We have in place a national strategy for financial education and financial inclusion. And in the last year or two, we have rolled out more than 1,000 centers for financial literacy in various, at the block level, not just at the state level or the district level, but at the block level. And you also know what is a kind of financial literacy measures that are being taken up, not just by the Reserve Bank of India, but also by other fellow regulators like SEBI or IRDA. We are also equally engaged with the media. We have taken up, you would have seen the various campaigns that we have rolled out, both in the print media and the electronic media, as well as we have involved communities through the social media. And the RBI Kehta Hai campaign has been quite visible. So there is a lot of work that has been done, which we would like to showcase, as well as draw lessons from and show it as a part of a G20 presidency. Very close to, allied to financial literacy and inclusion is payment system. And it has been acknowledged the world over that India has broken new paths, new grounds in the path of payment systems. Our approach to payment system has been, I will not say unique, but probably some of the other countries could look at it. We have had in place the Payment and Settlement Systems Act of 2007, which is the focus is on development of the payment and settlement system. We have today in place, you're all aware, we have a real-time gross settlement system, which is active, which is working 24/7. So 365 days, there are no holidays. We have a national electronic funds transfer system, which is also there 24/7. Then these are all, and the NEFT actually, and RTGS, even during the height of the pandemic, during the lockdown, they were active for 24/7. So pretty much the banking system and the payment system were not affected at all. You're all very familiar about UPI, which is pretty much ubiquitous, and you can carry out transactions for even as small as 5 rupees. And you're all, I need not go into the details, you're familiar with that. But this is something very unique. And for a country where financial literacy is not very high, the adoption of UPI has been absolutely, it is nothing short of amazing. So, and every passing day, and it's probably today in India, you can step out of the house without your wallet, but you need to carry a mobile phone. And we are also working trying to reach out to those areas which with very poor connectivity or no network connectivity, and offering technological solutions. We also have some experience in the last 2-3 years in the form of an RBI subsidiary, which is the RBI Innovation Hub in Bangalore. And that is a very interesting place to be in. Of course, there are technologically, you will find maybe more exciting work, more sophisticated work that is being done in the BIS innovation hubs in Basel and other places, but the innovation hub that we have here in Bangalore is purely for Indian problems and in coming up with Indian solutions. So that's another, aspect that we will be able to share with our counterparts during the G20 presidency. Coming to issues of other technological issues, mainly, which would mean primarily all the issues surrounding cryptocurrencies. You would have seen a lot of debates that are going on, and a lot of work has already been done by FSB in the area of crypto assets, and we will be working very closely with the FSB and other countries in taking forward the work that has been done in the area of whether it is unbacked crypto assets or stable coins. Very similar to this is the other issue related to cyber risks. As we roll out more and more digital products and take up more digital ways of reaching out to the population, we are also exposed to greater risks. And that partly comes out of lack of financial literacy as well. So this is an area where we have some experience as banking supervisors, because as you know, RBI is a full service central bank. And as banking supervisors, we have some experience in knowing the extent and the nature and the changing trends, changing nature of cyber risks that are taking place in the banking system. We have a database, and we have a cyber incident reporting system in place, which has matured now. And that is another area where we will be able to work with. And the ultimate goal is to expand the format for incident reporting in cyberspace, which has FSB has already worked on it. So we will be able to, our goal is to make it more, so that more and more countries adopt this format and share their experiences and cyber incidents for the benefit of all the other countries. Then coming to climate-related risks, we have made a beginning, and within the Reserve Bank of India, we have come out with a discussion paper on both climate risk and sustainable finance. I must admit that we are at a very nascent stage, but we have become a part of the NGFS, or the Network for Greening the Financial System. And we have made a survey of Indian banks, about 30 to 35 Indian banks, to understand where we stand. And the survey has been quite revealing. I must admit that it shows us very clearly that we have a lot of ground to cover before we catch up with the others. But we can assure you that work is afoot, and more work is being done, especially in the areas of climate risk, financial disclosures, and as well as studies like stress testing, which we would like to take up to understand climate risk that is posed to the financial system. And I left out. And finally, a word of CBDC you would have seen yesterday. The RBI we came out with a concept paper about nearly a month back. And then yesterday, from today onwards, we have announced a pilot on CBDC in the wholesale segment. And there are various use cases. And today we'll be trying out a few pilot transactions using CBDC for settlement of government securities transaction in the secondary market. And we also hope to, of course, there will be lessons to learn and build upon whatever we learn from the pilot transactions. And we also hope to roll out the retail segment of the CBDC in about a month's time. So I've taken about 12 minutes and I think, so I just wanted to very quickly sum up and let you know about, share with you the RBI's role and contribution and how we are going to contribute to the G20, India's G20 presidency under the leadership of the Government of India. Thank you.
Thank you very much, Mr. Subramanian, for giving us the perspective from the viewpoint of the central bank, and a very informative in terms of what's happening on issues of financial inclusion and other issues that you touched on. And I'm grateful to you for sticking to 12 minutes. It's always hard as a listed speaker to do that. Now it's my pleasure to invite Dr. Breuer to be the first discussant. And just to remind, 7 minutes if it's possible.
Thank you very much, Dr. Acharya. Thank you, Deepak and Mr. Vashin for the invitation to be here. It's a real honor and privilege for me to participate with a very distinguished group of policymakers, thinkers, and activists whose work has a huge impact on a large portion of humanity. After all, India is about 20% of the planet's population. So what happens in India is of much significance to the whole entire world. So thank you very much for this invitation. I understand I have about 7 minutes or less, so I'm going to be kind of quick and brief. Speakers before me have mentioned what a difficult context India is inheriting for its G20 presidency, still with COVID, high commodity prices, tightening financial conditions, slowdown in China, factors that are leading to a rise in inflation across the globe and slower growth. And unfortunately, the view from the fund is that things will get worse before they get better. And this happens in a context of geofragmentation and increasing protectionism across the globe. So it is very much of a challenging situation. At the same time, I think the world has a lot of hope and expectation for India's presidency. India is a systemic country, as you know. What happens here affects the world. Roughly 10% of global growth can be attributable to India last year. But beyond the numbers, India is at the center of most of the major global challenges, and India's cooperation and leadership is needed to face these challenges, whether it's COVID vaccination, climate change, SDGs, taming technology for the benefit of mankind, and so forth. The current situation, both the context and the challenges, will certainly require a strong effort from India to steer the G20 and garner consensus towards global solutions to global problems. The agenda described by Mr. Kant and Dr. Nageswaran is certainly very welcome. And the IMF supports it very, very strongly. At the same time, the world is subject to uncertainty, which means that maintaining some slack is probably the right thing to do. And the flexibility that the chief economic advisor described is a wise approach to take, because other issues might very well come up. Let me highlight some of the issues that, in the view of the IMF, are particularly important. It won't be exhaustive. We don't have the time, but at least I'll try to hit some of the main themes that, in the view of the IMF, need to be addressed by the international community, and the G20 forum is a very appropriate place to do so. One is supporting vulnerable countries, and India has done a lot over the course of its history and has a soft heart for developing countries that are currently being hit by high inflation, food and energy insecurity, financial stress, and possible debt crisis, as mentioned by the CEA. And the debt issue is, in the view of the IMF, particularly important, as mentioned by other speakers. The common framework, which is an arrangement to try to deal with the debt of low-income countries, needs to be strengthened. It was launched at the G20 not too long ago, and greater efforts are needed for that framework to succeed. And beyond that, coming up with rules to address emerging market countries that are dealing with financial stress. And Sri Lanka was mentioned earlier, but Sri Lanka is not the only country facing financial stress. Another issue where India can showcase its very important successes is digitalization. We've heard Mr. Kant, we've heard Executive Director Subramanian, the Chief Economic Advisor, describe this. And as an outside observer, as a fly on the wall, the Indian wall, I can say that what you have built in India, the Indian stack, is truly remarkable, unlike anything I've seen working many years around the world in economic issues. And there are a lot of lessons for the rest of the world. The payment system, the UPI, the leadership of the RBI in guiding both the public and the private sector in the payment space is truly unique, and a lesson for the rest of the world that at the IMF we're trying to disseminate. Climate change is an important issue, as mentioned before, and certainly those countries that have contributed to where we are, and those countries that have committed to transferring resources and technology need to deliver on their commitments. But that's not enough for India. India cannot wait for others to act, because India, as you know, is very affected by climate change and contributes to climate change. So Indian leadership, both through the LIFE program, which is truly an innovative idea that has been endorsed around the world, is a very important contribution that hopefully will lead to real change at the grassroots levels, changing lifestyles, which is what we need to do to get out of this addiction we have to fossil fuels. Turning over to the international financial architecture point elaborated by Dr. Gupta. Let me say two things. Number one, the world economy has changed dramatically in the last decades. Institutions need to adapt. Just like India now is a bright spot in the global economy, in part because it's harvesting many years of prudent economic policies and institutional reforms, upgrading the soft infrastructure that runs the economy, whether it's tax policy, the budget, the regulation of non-bank financial institutions, financial inclusion, the bankruptcy court, the GST, and so forth. And these reforms are producing dividends. The international soft infrastructure needs to be updated to a changing environment. And the IMF has been doing that internally over many years. Governance has been reformed, changing the quota system, increasing the voice of emerging market. Not enough. Much more needs to be done. But an initial step was taken in 2015. There's been a sharp increase in the transparency of the work of the fund and the publishing of the reports of countries' economies. The mandate has been adapted to include other global issues such as climate change, gender issues, inequality. And it's becoming a much more diverse institution, with a notable increase in Asian representation among the executive layers, including Indian and non-resident Indian presence. Now, in terms of the lending policies, Dr. Gupta mentioned a few of them, the FLL, the PLL, which are like contingent credit lines, and put forth some very interesting ideas that definitely need to be discussed. Obviously, many of these ideas were considered at the inception of these lending windows, which ultimately are approved by the international community. The fund is governed by governments, and the finance minister of India is the Indian government's representative, chief representative to the fund. But you also have an executive director that lives in Washington full-time representing India. And like him, there are 24 members of the executive board, and all of the fund policies are approved by the board. So these characteristics were widely discussed, and the current situation reflects the consensus of the executive board towards this new facilities that were created at the time. Currently, the fund is quite focused on strengthening the global safety net, and most immediately, because it's a time-sensitive process, focusing on the 16th quota review of the IMF. The quota is the capital base. It's the contribution of countries to the capital of the fund, which in turn can be leveraged and used to lend to countries in financial stress. So the last quota review, which was done 5 years ago, ended up with no change in the quota system, basically because at the time, the Trump administration, which as representing the US has a veto power on a number of decisions of the IMF board, did not want to increase the quotas. Now, the IMF considers it's very important to increase its capital base because this is the firepower the institution has to deal with global crisis. And as countries have grown, as the magnitude of the financial problems have increased, then so have the need for these resources. So in summary, this is a very unique moment that India takes over the presidency. We have great hopes for India's talent, for India's soft power, for India's leadership, to bring a fragmented world together and try to move towards global solutions to some of these very pressing global problems. Thank you very much.
Thank you, Dr. Breuer, for sharing with us the IMF perspective and reminding, I think, the audience that the IMF is, at least in theory, run by the governments that are the members of the institution. Though many who may have actually in real life encountered IMF missions would not perhaps see that link straight away. We think that the IMF is outside the governmental system, but thank you for the reminder. Now, may I request share the screen? There we go. Our last discussant, our second and last discussant, Ms. Nella Hendriyetty, who is the Director of the Center for Regional and Bilateral Policy, Ministry of Finance, Indonesia. A special welcome to you, coming as you are projected across the ether or the beams or whatever, from all the way from perhaps Jakarta. But unfortunately, we're of course running late, so I have to request you to limit yourself to the 7 minutes I had mentioned earlier.
Yeah, thank you, Dr. Acharya, and good morning, good afternoon to all the audience and panelists over there. Thank you for arranging this conference, and thank you for ICRIER and involved in many years of your events already. And then we have partnered in many projects, in several projects in my previous position as well. So in my presentation today, I would like to update you about the work in Indonesia G20 presidency. I'm not gonna explain all the topic priorities in Indonesia finance track presidency. I think everyone, every panelist already mentioned that before, like a capital flow, about IMF quota review, crypto assets, CBDC, financial inclusion. I think the one that I need to mention that we Indonesian presidency also have this financial intermediary fund to address the pandemic, and then we also established this joint finance and agriculture minister meeting to address the food insecurity problem. I think this will continue next year. And I think the climate change and there's a lot of topic will be discussed in the India presidency next year too. So in my presentation today, I will focus on the framework working group G20 meeting, and then I think one of the panelists today, Mr. Anantha Nageswaran, are also the co-chair of this framework working group. Anantha, please allow me to talk about our working group here and what Indonesia expectation before designing the topic, and then what deliverables that we have in almost the end of our presidency. If please allow my team to share the screen, so I will try to be on time. So can you see my screen? I don't. So so under Indonesia G20, can anyone see my screen? Is that
We cannot see your screen.
Okay.
Need technical help on being able to see the screen, please, from someone.
Yeah, I think I will try to share my screen by myself then. Sorry about that. Can you see my screen now?
Yes, we can.
Yeah. So under Indonesia G20 presidency, the framework working group has implemented a work plan which advanced the FWG core mandate in the context of the recovery from the COVID-19, generating a lasting legacy of benefit to members and contributing to the efficacy of the G20 more widely. The work plan was delivered mandate from deputies to further explore the macroeconomic impact and risk linked to both the physical and transition risk of climate change and the associated policy implication, along with the presidency priorities, and to consider appropriate exit strategies to minimize economic scarring. As part of the work plan, the FWG also explore ways to enhance policy preparedness and coordination in dealing with global risk. So during 2022, Indonesia presidency FWG discussed the three priorities. First, the maintaining a strong, sustainable, balanced, and inclusive recovery from the COVID-19 pandemic while managing the risk. So we discussed the working group continue to assess the global economic outlook and prospect for the recovery, including exploring, analyzing that focus on the scarring caused by the pandemic, G20 policy cooperation, implication for the near-term outlook for supply pressures, and how the global economy can build back better through reforming and supporting economies. And then the second one, the global economy risk over the near and medium term. Under this area, the activities include updating the risk list, reviewing framework and discussion on financial vulnerabilities. And the third one, we monitoring climate-related macroeconomic risk and implication for macroeconomic policy. This area focus on climate change issue. I think that's also discussed by other panelists. That climate change also have impacted the macroeconomic risk. So the climate change issue which has clear macroeconomic implication and risk, and has increasingly featured in FWG's risk discussion over recent years. So in 2022, FWG was discussed the monitoring and systemic analysis of climate-related risk and the impact of for macroeconomic policy transition strategies, and that's also different across countries. And in slide 4, oh yeah, I moved this. So and then after we just start our presidency, and we experience the risk has shifted from only like a focus on the pandemic. Now we face that various global shocks. So in the beginning of the presidency, we start with the optimism about the COVID-19 pandemic, where the situation improved and the well progressing of vaccination. However, downside risks to the global economy have shifted toward various shocks in the global environment, such as persistent high inflationary pressure, nudge central bank to sharpen and broaden monetary tightening policy, causing financial market volatility and capital outflow from emerging economies to advanced economy, as discussed. And then also food and energy insecurity, stagflation and recession probability and geopolitical fragmentation risks are soaring. The G20 forum has to adapt and work together, I think, in the discussion to find a solution on the escalating risk. So I show you in the next slide how the evolution, how the development in the working group meeting. So the first working group that was in January, that was held in virtual, we talk about the recovery effort and policy challenge from the COVID-19 pandemic remain at the center of the agenda. So the meeting discussion focused on the 3 main issues: global economy and health outlook, focusing on the emergence of new COVID-19 variant, the Omicron, including its impact on the global supply chain, global risk monitoring and prioritization of risk, and the policy response to inflation and implication for macroeconomic policy, including exit strategy and scarring effects. In this meeting, members agreed that securing vaccination rates and vaccine distribution globally remains imperative. Members also agreed that calibrated policy are needed to secure global economic recovery from the implication of high energy prices, labor market mismatch, and supply side disruption, negative spillovers, and inflation. And now we come to the second FWG meeting that took place in May, that was in hybrid meeting. But in between in May and January, there's a lot of happen. So we have 2 ministerial meeting, one in February and one in April, and in the between there's the war in Ukraine starting. So at the first ministerial meeting in February, the war still not started yet, but we feel the tension already, and then how hard is that to achieve the communique. But then we achieved the communique, and then in the war started, and then in April in the spring meeting in Washington DC, we try to have the communique, and we have the challenge to keep the G20 as a multilateral forum, and then to address all the interests from the members. And then fortunately we can secure the chair summary, but it's only circulated among members. And then I think since that time, I think the mechanism also followed by other ministerial meeting, that we only issue the chair summary. And I hope, I think India presidency next year that can have a better way to keep the multilateralism in G20. And then, yeah, like Anantha said that we can make the difference for the better world. So I hope we can find solution for all the difference and polarization in the world. So let me come back to the second FWG meeting in May. The focus on the global economy outlook and risk that caused by persistent inflationary pressure and the rising cost of living, including concern around energy and food security, heightened geopolitical tension due to war in Ukraine, as well as the impact of stricter monetary policies in many countries. So the FWG also discussed about the macroeconomic implication of climate change and climate mitigation strategies and exit strategies and scarring effects. Based on the discussion in this session, all members agreed that global economy is facing sustained uncertainty and challenge, and there was an idea brought up about the need for global awareness of food energy security, which may hinder recovery. So the discussion on the macroeconomic impact on climate change raised the importance of G20 members to pursue collective action and to pursue green transition while considering domestic circumstances of each member. The group also considering also highlight the importance to consider the issue on the agenda, particularly on macroeconomic analysis and modeling to understand further climate change related risks. This includes how the FWG can leverage its expertise to address the challenge, as well as how to collaborate with other relevant G20 groups. So, and then in this meeting, we highlight several points. And we have the finding of the survey regarding exit strategy and scarring effect from the pandemic. As I mentioned before, this survey was one of Indonesia presidency key deliverables. The survey were based on the response from members, as well as analysis from the IMF and OECD and related experts. So the survey findings were outlined in the G20 presidency note on policy setting on exit strategy to support recovery and addressing scarring effect to secure future growth. The document was endorsed in the chair summary of the third finance minister and central bank governor meeting in July 2022. There are several points that could be highlighted in the survey, which includes first, a country fiscal position determines its policy choice, both in terms of exit and scarring. The second one, there has been shared views regarding the need to implement gradual exit strategy. The third, every country considers their own domestic factors and circumstances when undertaking exit strategy. Fourth, there is a need to have a clear communication and in implementing exit strategies in order to anchor expectation and mitigate spillover. And then on scarring, many countries experience disruption in supply chain, which lead to rising inflation and lower investment. Meanwhile, digitalization is raised and there have been shifts in labor markets. The survey also found that contact-intensive sectors are most hard-hit sectors by COVID-19 pandemic crisis. In the third FWG meeting, this is the last FWG meeting under Indonesian presidency that was held on September 2022. The meeting was focused on global economic outlook with a particular focus on compound risk and macro fiscal policy, high food prices and food security risk, and macroeconomic impact of climate change. As we know, various near-term macroeconomic risks could compound and exacerbate recessionary pressures, such as higher inflation and lower growth. And we need to monitor and mitigate the longer-term risks, namely climate change, energy, food insecurity, and economic fragmentation. And then here I highlight the communique or the chair summary that we have during Indonesia presidency. So on the FMCBG meeting, initially, yes.
Running out of time.
Yeah, I will try to be sharp. So we have 4 statement. Actually, 1 is communique and 3 is chair summary. The second chair summary, actually, that's the first one that we address, the humanitarian crisis, economy, and financial impact of the war, and that's the discussion quite hectic. And then we go to the slide 10. So I think we can skip this. I think I will go to the summary. There's a lot pending issues actually during Indonesian presidency that still need to be carried over to India presidency because of the new development in the world. And then beside the priority of India itself, we have kind of like a food insecurity issue. Like Anantha mentioned, that we need to manage the spillover effect of the this geopolitics, and then we also have this pending and ongoing issue on taxation, climate change, and then so I think infrastructure development, and I think I stop here. Thank you.
Thank you very much, Ms. Nella, on giving us such a full and detailed account of the work of the framework working group in particular, but also overall, and where things are kind of you, Indonesia, are leaving it, so to speak, for India to carry on the good work and face the mounting challenges in the world economic and political framework. Thank you very much for your contribution. Now, because we are running late and there's a full day seminar with lots to go, we're going to have to skip a couple of things. One is, of course, there's absolutely no time for a Q&A, so that's regrettable, but that's the way it is. And secondly, I'm sure that Puja Mera would have prepared an excellent summary, which we would have all learned from, but I'm afraid maybe you can, with Dr. Mishra's consent, circulate it in an email later to panelists. I leave it to you. But we're going to have to forego that. And I'll spare her the effort of doing a vote of thanks by giving a vote of thanks myself to all concerned. In particular, I'd like to thank the main speakers for the trouble they've taken and the content and substance they've brought to this discussion to make this an excellent session, and of course to both the discussants who contributed very much also to the discussion. So with that, I would like to conclude this session, and thanks to all of you for being patiently listening, and I hope that you took away some of the wonderful substance and discussion that we had with you from this session. Thank you very much.
Thank you very much. We now break for lunch and we resume at 1:25 p.m. IST sharp. Thank you very much.